Some investors spend years trying to beat the market, while others take the complete opposite approach. They just invest in the entire market and do absolutely nothing. Two totally different mindsets. And yet, both claim to be the smart way to build wealth. So who's actually right? In this video, we're diving into one of the biggest debates in investing: active versus passive investing. We'll break down the real difference between the two, look at what the data actually says, and find out which strategy truly wins in the long run. Welcome to Martic Finance, where we explain investing concepts in a simple way. But first of all, a quick disclaimer. This is not financial advice. So before we compare which one actually performs better, let's start with what they really are. Active investing is all about trying to beat the market. And what that means is simple. You're trying to earn higher returns than the overall market, usually measured by something like the S&P 500, which tracks the 500 largest companies in the US. If the S&P 500 goes up 8% this year, an active investor wants to make 10%, 12%, maybe even more. Rather than buying and holding an S&P 500 index fund, active investors pick individual stocks, bonds, or funds they believe will perform better than the market as a whole. To do this successfully, active investors rely on research, data, and timing. They study company reports, analyze financial trends, track earnings, and pay close attention to news and market signals. There are a few common ways people practice active investing. The first is individual stock picking, buying and selling shares of specific companies you think will do better than average. For example, an active investor might choose to invest in a company with strong fundamentals, one that shows healthy revenue growth, low debt, and consistent profits, but whose stock price hasn't yet caught up to its real potential. The idea is that, over time, the market will recognize the company's true value and the stock price will rise. Alternatively, an active investor might focus on a specific sector they strongly believe in, such as renewable energy, tech, or others. Now, if you don't want to pick individual stocks yourself, one option is to invest in actively managed mutual funds, where a professional fund manager makes decisions on your behalf. These managers study financial data, track market movements, and frequently adjust the fund's portfolio to take advantage of opportunities they believe will outperform the market. Another option is active exchange-traded funds, ETFs. They operate similarly to mutual funds, but trade throughout the day like individual stocks, offering more flexibility. Active ETFs are often focused on specific themes or strategies. In both cases, investors rely on professional expertise rather than managing each stock on their own, while still aiming for returns that exceed the overall market average. Active investing has several advantages. First, there is potential for higher returns. If an investor makes smart decisions, they might outperform the market significantly. Second, it offers flexibility. Active investors can respond quickly to changing conditions, such as buying undervalued stocks during a dip or selling before a downturn. Finally, it provides opportunities in all markets. However, there are also downsides. Beating the market consistently is extremely difficult. Additionally, fees are another drawback. Active funds often charge management fees of 1% or more per year, which can significantly reduce long-term returns. And finally, active investing takes time, effort, and expertise. Researching companies, tracking performance, and managing emotions when prices move quickly can be challenging, especially for beginners. Passive investing takes a very different approach from active investing. Instead of trying to beat the market, passive investors aim to match the market's overall performance. This is usually done through index funds or exchange-traded funds that track an entire market index, like the S&P 500. When you invest in one of these funds, you're effectively buying small pieces of hundreds or even thousands of companies at once. The philosophy is simple. Don't try to pick the winners, own them all. Passive investing has several key advantages. It's low cost, because index funds and ETFs don't require expensive managers to make constant decisions. For example, a typical index fund or ETF might charge an annual fee, expense ratio, between 0.03% and 0.20%, meaning you'd pay $3 to $20 per year on a $10,000 investment. It's also simple and time efficient. You don't have to spend hours researching companies or watching the market. Historically, passive investing has delivered strong long-term performance, since markets tend to grow over time. And it's emotionally easier, because you're not constantly buying and selling or reacting to short-term volatility. However, there are some downsides. Passive investors have no chance to outperform the market. By design, they can only match it. The strategy can also feel boring, since there's little active involvement or excitement. And, of course, passive investors are still exposed to market downturns. When the entire market drops, their portfolios drop too. So, how do active and passive investing really compare in the real world? The numbers tell a pretty clear story. According to the S&P Indices versus Active, between 80% and 90% of actively managed funds fail to outperform their benchmarks. That means most professional managers, with all their research teams and trading tools, still end up earning less than the simple, low-cost index fund that just tracks the market. One of the most famous examples of this came from Warren Buffett's 2008 $1 million bet. He challenged a group of hedge funds to see whether they could beat a basic S&P 500 index fund over 10 years. When the bet ended in 2017, the results were clear. The index fund earned about 7% per year, while the hedge funds averaged less than 3% after fees. Even the best professionals struggled to keep up with the simple passive approach. Another piece of evidence comes from studies of average investor performance. Research shows that most individual investors underperform both the market and professional funds, not because of bad luck, but because of emotional decision-making. They tend to buy when prices are rising out of excitement and sell when markets fall out of fear. Combined with high trading costs and fund fees, these emotional moves eat away at returns over time. Active investing can make sense in certain situations, especially for those with the time, knowledge, and discipline to research markets deeply. Investors who focus on smaller or less followed companies, or who have access to institutional tools and data, may occasionally find undervalued opportunities the broader market has missed. Over the long run, the evidence overwhelmingly favors passive investing. Low costs, diversification, and the power of compounding make it difficult for even skilled professionals to outperform a simple market tracking fund. And because passive investing requires little maintenance, it encourages better habits, steady contributions, minimal emotional trading, and long-term consistency. That doesn't mean you must avoid active investing entirely. If you genuinely enjoy analyzing companies or following emerging sectors, allocating a small portion of your portfolio to active ideas can be both educational and engaging. And that's all for today. If you found this video helpful, please consider subscribing and smashing the like button to continue growing this community. Thanks for watching, and I'll see you very soon. Bye.